Okay. Announcements. If you hadn't seen these and if you hadn't applied, please do apply. And if you have already applied, sorry if I'm trying to drum up the competition. But there is 2 scholarships out there. School Business Administration has one. It's a Community Trust Bank. It's $2,500 for your senior year, and it's $1,250 a semester. And to be eligible, you just have to be a School of Business Administration full-time student. You have to have senior status, so you have to have 90 hours by the start of the fall semester. Have to have a cumulative GPA of 3.0, and you must live in one of these counties. And sorry, you're left out there, sir. Boyd, Fleming, Floyd, Knott, Letcher, Montgomery, or Pike counties. I assume that's where community trust banks are. You need to get an application. You can either go online at the College of Business website, or you can go to the Dean's Office 214 and get an application. And submit it by March 1st, which means Friday. It has to be submitted Friday. And you'll be notified on April 1st, and then we have a honors lunch, banquet on May 3rd. That's the last day of class on Friday, May 3rd. And another one just for accounting or finance majors is the Greg Treat Memorial Scholarship, and it's $5,000. It's 20, which means $2,500 a semester, but it says it may be renewable if the academic criteria are maintained. And you will be also recognized on a student honors night, but all you have to have is 60 credit hours at the end of this semester to be eligible. Then increased GPA though, 3.5 is what it's wanting. And unmet financial needs is determined by the Office of Financial Aid. They do look at financial need. Hey, I need 5,000. But the applications, again, are in Dean's office. It is online, so and it needs to be no later than March 1st. So you got Friday deadline, and so the Dean wanted us to make sure everybody knew what's available. Also, job fair is next Tuesday, I do believe. And I sent the emailed stuff out to you, and of course there's posters everywhere around here. And for people online, you're eligible too. Take advantage of it. Go over there, see who. Again, let's go over and notice what jobs are being advertised. If nothing else, do a survey, even if you're not interested in anything. And also, if you are, I practice interview with them. You don't have to tell them I don't want this job. You don't be dumb. Go in and talk to them. And again, how do you improve your interview skills? You practice, and there's a great place to practice interview. Don't forego the advantages that we do offer, because again, we don't offer it. And by the way, don't be like a lot of people. Don't be apologetic because you're coming from Moorhead. A lot of our students do very well against head-to-head with other universities. So don't take a back seat to anybody. Many examples of people that have went from here and done really, really good. And in fact, a lot of companies are coming back looking at you guys because the people ahead of you have done good. And we got some companies who wouldn't even give us time of day. And they actually hired 1 or 2 of our people, and all of a sudden they moved right on up to corporate headquarters, and they're going, these people are pretty good. And so they're coming here talking to you.
You know who Jim Booth is?
Yes.
Wasn't he an accounting manager here? That's what I've heard.
I think so. Yeah, you'd be surprised some people who come from here and went on to greater things than this. We got, like I say, I probably told you this story, but I'll never forget Anita Vantaventer. Can't forget a name like that. Great lady. Or girl, student, whatever, young lady at the time when I had her in class. Obviously, she was a traditional student, and she graduated, got a job at Ashland. In fact, she wasn't from Ashland, but she got a job with her. So we would meet for lunch every now and then and talk. And, she's the one that made the statement that one time. I know I've told y'all in another class that she hated her job. I said, why? She goes, it's like doing intermediate homework 8 hours a day. I said, well, what were you thinking? That's what accounting is. And but the guy she worked for, she worked more than 8 hours a day. That's what's good. She averaged like, her first year she was averaging 70 hours a week, per week. I mean, she got paid for it, but it's hard to live like that. You gotta have a life outside the job too. And so she was looking around and she went to interview for a company and an organization in Lexington. And we all know what's in Lexington, UK. And she interviewed for the job, and it was to be the chief accountant for the organization of American State Government. They have the national headquarters in Lexington out by the horse park, I think. And I never even heard of it until then. She was telling me that she'd interviewed, and of course she's interviewed by a group of like a dozen people. One of these nice big formal interviews at a nice big conference room, she said. And said she walked in there and they were interviewing and asking. Finally, one of them asked him, said, well, how do you compare your education at Moorhead as opposed to the University of Kentucky? And she looked at him and says, I consider it better. And I said, well, I bet that dropped a few mouths. And she goes, yeah, I got some looks. And they said, well, could you explain? She goes, yes. If I didn't understand something, I used to go to the professor's office, but she did. And guys, y'all can too. I mean, my door's, and by the way, if you come to my office and the light's on, I'm in the building. And I keep the door closed for a simple reason. You notice my computer, my back's facing the door, and I don't like to jump off the top of the ceiling when somebody goes, hey, it scared me to death. So knock on the door, and if I'm not there, come on usually I'm on the second floor, one of the offices there, just walk around and see me. But I'm glad to have, usually officers that try to stay by the office. But anyway, she says, when I had a problem, I'd go to my professor's office, they would sit down and explain it to me one-on-one. She goes, I don't think I would have got that treatment at UK. She got the job. I don't know if that was a good answer to give or not, but she got the job and she's done well. Done very well. Okay, let me get rolling and then we'll get back into this stuff. Caitlin, what's that old Steve? Matthew. Lauren, Jerica, Brandon, Mason, Travis, Leslie, and Alexis. The important ones are here, right? That's the thing, the important ones. The rest of the people, yeah, who cares about them, right? We can talk about them, they're not here. Okay, I think we left off talking about residual income, right? We're going to look at some exercises and how to work it, how to read it, and some about it. But I said, and again, what's residual income? What is residual income? Somebody give me a definition of it. You may remember. If you remember how to calculate, that's pretty much the definition.
Basically just your income in excess of your cost of capital.
Okay, found the right page, huh? Everybody's flipping through trying to come up with it. Again, residual income is your after-tax income, actual profit, if you want to say, minus your cost of invested capital. And you say, what's your invested capital? Well, basically is your cost of capital times your divisional assets. Now, how do you get cost of capital? Well, basically, where do we get our assets from? That's a good 281, counting 281 question. How do we get our assets?
Financing.
Okay, how do we finance?
Issue debt and some.
We issue debt, either bonds, notes, whatever. That's right, liabilities. How else? How else do we get assets? Equity. Owner's investment. Owner's equity. Again, we just go back to accounting 281. What's the old balance sheet formula, the accounting equation? A equals L plus OE. Well, another way of looking at it, assets come from two sources. Either creditors provide them or the owners provide them, right? And usually a combination of the two is what we run into. Now, you know, let's see if we can look at this example up here. If I can get it on the right source. That's the wrong source. Wait. That ain't showing up worth it. Angle tube. I don't want that. There we go. Example. Again, just going through a little bit. Occasionally, cost of capital is a weighted average. Here's one way to come up with a cost of capital from source. Debt. What's it costing us? Our money, our debt, and our equity there. And again, obviously debt is going to be your interest paid, which is tax deductible. And equity is the stockholder's opportunity cost. And remember, if opportunity cost, if we do option A, we can't do option B type thing. We can't obviously invest it with us and can't invest that money elsewhere, what we're talking about. And so it doesn't have tax implications because dividends and things do not have a tax complication. And again, that gives a relative, we just proportion it out. Now again, you do have to adjust it for the debt for the after-tax consideration. So, here we got $1 million in mortgage bonds with an 8% interest rate, $2 million in unsecured bonds, 10% interest rate, and $3 million in common stock with opportunity cost of 12% for the stockholders, and the tax rate is assumed to be 30%. What would be the cost of capital that we use? Again, notice we got 1/6, 1/3, and 1/2. That's where that percentages are coming from. The after-tax rate, 8% times 70%, 10% times 70%, and again, times the weighted. So, 0.167 times 0.08 times 0.7 comes up with 1%. 0.333 times 0.1 times 0.7 gives you 2.3%, and 0.5 times 0.12 you'll come up with 0.06 or 6%. If you add it up, we would assume that this company's cost of capital is 9.3%. They would look at projects and calculate their ROIs as 9.3. Now, in all probability, they're probably just going to round that up to 10% in real world terms. Now again, this is one way to come up with it. Another way is just that manual says this is what it is. And you say, why'd you come up with that? I threw a dart at the board and that's what it hit. I mean, as frivolous as that sounds, that's sometimes what you get. And like I told you the other day, I asked a question. In summer school, they make a distinction between 1-200 level classes and 300 and 400 level classes in terms of what's full enrollment. And my question was, well, the tuition's the same, isn't it? Why is there a difference? And I got the great answer, well, that's because it's always been that way. And I was like, huh? That's your reasoning? And I should have known better, because years ago, when we started doing online classes in the summer, I have never taught a 4-week course online, and never will. Because it's just, I mean, you got to cover 3 or 4 chapters in a week online. That'd be a lot. You got to be constantly at it. Even live, it's tough because it's 2 hours a day, 5 days a week. And so it doesn't give you any turnaround time online. And So I always did it by 8 weeks, the full 8 weeks, summer 1, summer 2 together. We couldn't, they wouldn't put an 8-week session on for us. And we would ask, well, why can't we just have an 8-week? Well, we've never done that before. And what it was, I think part of it was they didn't have anybody that knew how to program their student program to accept an 8-week course. Now we've got intercession, we got 8-week courses, we got 4-week courses. We got somebody up there that knows how to program finally. But what we used to have to do, I used to have to teach an 8-week course. I had to give everybody incompletes on the last Friday of the summer 1. And then at the end of summer 2, we had to go in, I had to fill out a form for each student and change that I to their grade, and which was ridiculous. And they had to process all those forms. It's like, guys, wouldn't it be just easier to have some programmer come in and put in an 8-week session? But again, you know, and you run into that, and cost of capital, a lot of times it's just, well, we feel like this is the right one. You know, the Ouija board said. You do run into that, and I know it sounds frivolous, and you think, well, they don't run companies like that. Oh yeah, they do. Best example I got at Steel Mill, we had a belt that was that much too short. Didn't fit under the side guide, and I had iron ore falling down on it, and we just had to shovel it to the side during the week. On Wednesday day turn was the only turn that we didn't operate, 21 shifts a week. And they would have six or eight, we call them green hats, because when you first hired in, you went through labor reserve and everybody wore a green hat. That's to let us know you didn't know how everything worked and to help make sure you didn't get in trouble or in danger. And they would put them in there cleaning, shoveling that room out, cleaning it out each week. Now, 6, 8 men and women, paying them 8 hours each. And we did this for over 2 years, and we kept begging them to buy a wider belt. How much you think labor they spent in 2 years before they finally got around to buying the belt? I bet they paid for that belt 50 times over. And you say, what would it take? Within that 8-hour time, they could have had maintenance come in and change that belt out to one that was about 2 to 3 inches wider, and you wouldn't have had the mess. And the thing of it is, if it piled up enough, it would burn the belt up, burn the motor up. Then you're talking even more expense. So it's not just the paying the people keeps that way. And again, do companies operate that? Yeah, this was a big multinational company. Conglomerate, done the insurance companies, steel mills, and we couldn't get them to buy a belt, conveyor belt. And yeah, that companies do things like that. So it's sort of interesting what you run into. Now, again, once we come up with cost of capital, residual income is relatively easy. Simply multiplying the cost of capital to the invested assets and subtract it from the profit. Now, the thing about it is, if it's positive, then we go, yay, we like it. As long as it adds $1. Now, obviously, the more the better. Now, if you get a negative number, then you would turn the thumbs down on it. Now, the thing about to remember, typically, what you're thinking, the relationship here with ROI, if you come up with a negative residual income, that means you're actually earning less than your cost of capital. If you get a positive number, you're earning more. Your ROI is greater than your cost of capital. Now, this does help get around one of the hang-ups with ROI in that, as long as if we're using residual income, as long as it's positive, it's increasing that department, subunits, residual income. So anything it adds to it, management's more likely, the division heads are going to say, yeah, okay, that's fine. And we don't run into that sudden optimization problem when, okay, ours is 22%, this project's only 19%. Yeah, our cost of capital is 12%, but I don't want to reduce the department ROI, so we would turn down, thumbs down, even though it's almost double what the cost of capital is for that department. And if we use a residual income, we're probably going to say, oh yeah, sure. It's going to add to it. It's in dollars. It's not a percentage. What we're coming up with. Okay. A couple of ones I was wanting to look at that I thought made sense. was 21 and 26. We didn't look those, did we? I don't think. Go back that minute. I'll get in EVA. 21. What's going on in 21, sir? We'll let you learn ramrod on 21.
It says the TL division of Giant Bank has assets of $14.4 billion. During the past year, the division had profits of $1.8 billion. Giant Bank has a cost of capital of 8%, ignore taxes.
Okay, it says this come up with divisional ROI. Can anybody give me the ROI? .5%. Again, all we're doing is taking 1.8, what is it, billion, isn't it? 14.4 billion. Now, if our cost of capital is 8%, what can we surmise about residual income? Is it going to be positive or negative?
Awesome.
It's going to be positive because, again, ROI is 12.5. If cost of capital is 8%, 12.5 is more. So I would expect to come up with positive residual income. And so how much residual income do we have? Well, we got what, again, 1.5 billion, right?
1.8.
1.8, excuse me, billion. And from this, we're going to subtract out what?
Oh, wait, 14.4.
Yeah, 14.4 billion times 0.08, wasn't it? So what do we come up with residual income? Again, that's ROI. Residual income. What's your calculator dials tell us?
Um, 64.8%.
It's not percent. Residual income is going to be dollars. And I know with this billions and all these programs, you can't do that calculate. That's actually 648 million, I think.
Thousand. Or
That's million, isn't it?
million.
648, 6 zeros would be the residual income. Yeah, granted, the high numbers. That's. But again, notice here though, we're not dealing with the ratio. ROI is a ratio, residual income is not. And so when the manager's looking at this, all we're looking at are projects when we're using residual income. We're just looking for projects that increase residual income. Again, if it's positive $1, it increases. Because the department residual income will always equal the current residual income plus the residual income from any other investment. And so if it's positive, it increases it. And again, if we're being evaluated on residual income, we like things like that. And so it does do away with that sub-optimization problem we had with ROI. And you try to come back with it. Now again, it doesn't totally eliminate that sub-optimization problem. You don't get totally rid of it. There can still be a conflict in decision criteria there. Again, with how we measure and the performance and all that. And the reason for that is just like ROI, what are we using to calculate it? What are we using? Well, net income, profit, and what else?
Assets.
Invested assets, right? And we get those numbers from where? Our accounting records using GAAP. And so we got some problems inherent with, well, how we come up with that. You say, what do you mean? Remember, like R&D and all that, we expense it in the period incurred. We're following GAAP, and that's one of the negatives that we have when we get the EVA, that economic value added. That tries to help to account for some of that and get around. But again, residual income does still have that same problem along with ROI, but it's a little bit better in terms of sub-optimization. It's not perfect, but it can be a little bit better. And again, it's a little myopic, like ROI is still with using net income. And that's why I say we get to. Now, 26 I also said, and it says there we got residual income measures and new project consideration, and again we're referring back to information in 24 and 25. And we look at, it says, what is the division's residual income before considering the project? So you got to look back up there to 24, and we see that Ocean Division currently earns $780,000, has divisional assets of $3.9 million. And it says the company, last line there, or right before ignore taxes, it says the company's cost of capital is 15%. So can anybody tell me what the RI is with that one? Guess I can turn that one back on. What'd you get?
195,000.
195,000. Yeah. What was it? 780. 780 is the profit, and we got how much? 3.9 million. Got 3,900,000 times 15%, and 195 is residual income there. Okay. Now, we got some options going on here. It says, what is divisional residual income if the asset is purchased? Well, let's go back up to 24 and look, and it says, the division is considering acquisition of new assets to add profit. The asset will, the investment is $675,000, has a yearly cash flow of $168,000. So let's come up with what the RI is for that. We did this one. We did ROI on this problem. I remembered it. So now we're just looking at residual income with it. I think I remember what. I'm sitting there trying to calculate in my head. He's looking over there laughing at me because I'm sitting here trying to figure it in my head.
Is that 261, 750?
No. You're forgetting a step.
Is it 149?
She didn't forget it. 149. Let's go back in, and there's a couple of different ways we can calculate this. You want to do the shortcut or the long cut? How'd you do it? We'll do it.
Well, I added the profit from new stuff, so I did.
Add it to what?
Added 780 to the.
Okay, you did the long way.
Okay.
Okay, that's fine, that's fine. You know, we got this here, right? 780? Well, if we add this project to it, we're adding, what was it, 168,000, right? And so that's 948,000? Now, is that the net income we use? What we gotta do?
Subtract that depreciation.
And I think that's what I was trying to calculate in my head there. You're laughing at me. You take that 675,000 divided by 6, that's 112,500, I think, right? Straight line, 6 years, zero salvage value. Again, in case anybody's wondering, and that is depreciation expense. And so we have to subtract that off. And we get 500 and, 6, 3, 8, 36, 500, that correct? Did I subtract correctly?
Thanks to.
35, you're right. You can carry that one over there. Okay. Now, that's going to be what I subtract from my cost of capital, right? Now, over here, I took 3.9 million times 15%. Is that what I take 15% of? What we do there
You have to
then?
add 675 to 3.9.
Okay, so I'm going to take the 309,000 plus the 675 because that's equipment I bought, right? And so now I've got what, 4,575,000? And so now I'm going to take this 83,500, subtract out 4 million. If I can write, that'd be dangerous. And you said that equals 149,250? Okay. And that is correct. There's another way to calculate too. Does anybody try it? You could find what the residual income is for that project and then just add it to the 195. Because you already found out the 195, right? So you could have just said 168,000 minus the depreciation of 112,500 is 55,500, right? And then we can take that and subtract out the 675 times 0.15, and what we do when we get that?
Negative 45, 750.
Negative 45, what?
750.
750. And so 195 minus 45, 750 is 149,250. Now that's an easier, shorter way to do it. If you've already got the residual income, just get the residual income for the project and add or subtract. In this case, we would subtract it because it's actually reducing. So what can we say about the project we know right offhand? That it, what's it earning? Less than 15%, right? Because ROI went down. I mean, excuse me. Well, we know ROI went down, but residual income went down. So we know it's not, this was negative, we know it's not earning 15%. Okay? So, nice little feature to know that you can shortcut it a little bit, right? Well, now what option C is, we're gonna rent it, right? Or lease it? What's residual income if we lease it? It goes up there. That's in 25, it says we can lease that same equipment on a year-to-year lease for $148,000. You can't calculate that in your head? Lee, yeah, you use a calculator for that? That's easy.
You know that.
Huh?
You know the calculation is gonna have stuff like, how long it should be to know that.
I could do this in my head when I was in 3rd grade.
Then
Yeah, I mean, what we got to do? Let's go over here and calculate that. We got what? Oh, we can do all this. We see we got what? We got our income was what? 780, and we add 168 to it. What else do we do? Subtract out 148. All right, that gives us what? 800,000. And then from that, we're going to subtract out what? 3.9 million times 0.15. And what do we get?
250.
Yeah. See, you can't do that. All you got to do, guys, is say you're going to earn 168,000. It's cost you 148. That's 20,000 more. 20 plus 195 is 215. So yeah, I could do that in 3rd grade. 20,000 plus 195 is 215. That's all you had to do. You didn't have to do all that. Yeah, gotta learn tricks. Makes life easier when you think about it. Instead of having to go through and calculate all that. Let's say, hey, project provides, I'll make 168,000. Cost me 148,000 to lease it. That's 20,000 residual income plus 195,000 I already had. Residual income on this project would be 215. Or if you want to go through and calculate all that, you can. Either way, whatever makes you happy, doesn't matter. Now, I'll be honest with you. If I was sitting there working on the project, I'd probably do the 195 plus the 20. If I'm presenting it to my boss, I'm probably going to show him that calculation. Say, look, brain power. Look what I did. Right? But both of you get you back to base either way. And it is good to know both ways to check yourself. Check yourself. That's why I'm trying to get you, sometimes show you 2 different ways of things. That you can't get in the front door, learn to go around back door, the back door, get through a window. There's got to be a way. And because in the real world, guys, you don't always have all the data in front of you. You got to work with what you got. So you go, okay, how can I back into this number? And for those that are taking auditing, that's basically what a lot of auditing is anymore. Is looking at logic and saying, okay, if this is this, then this is what this should be, and you work yourself into it. And if it's not, then you start going, why didn't that work that way? That's where you find a lot of problem areas. That's how you identify things that you want to look at closer. Because otherwise, in auditing, you'd have to go back and reinvent the wheel and do everything if you did 100% audit. And nobody has the time nor the money to afford an audit like that. And so what we do is we try to look for what problem areas are and learn how to look for logic. And that's what we're trying to get y'all to get here too. Okay? So, residual income is not one that's all that bad. Hopefully we can look at it and say, oh, well, that's relatively simple. And now, and everybody's going, hey, put that on the test. By the way, we are scheduled for the test next Wednesday. And really, we can take it Monday, but I'll keep it on Wednesday because we got 3 or 4 people taking intermediate on Monday. But what I will do, probably will finish this chapter up on Friday with me doing the next chapter on Monday. But then we will have test on Wednesday. Format will be the same as first test, all the way around. And I think it's 6 problems just like the last test. I calculated all of them the other day, worked them all out.
You get them right?
Now I got 78%, but I was hoping to improve on the second time around. Now again, residual income, just going through that, cost of capital, opportunity cost of our resources, again, equity and debt. And by the way, that's what's going to be guiding us. Even if management says, no, we want to set at 12% or whatever, when we calculate at 9.3, obviously, in setting at 12, they've got to look at what are they paying for their debt? What do we feel is the cost of it? And again, the debt was pretty much set in stone. You know what your interest rates are there, and you can come up with it. The play area, even with residual income and doing the cost of capital, like the example I showed you, anybody think, where did they get to 12%, or what was it? 12% on what they figured the common stock, the equity investment. Where did 12% come from? Opportunity cost. You still got a little play area there, right? Even we state all this, but even so, you're still wiggle room. Like they like to talk about, managers will say, hey, you gotta give me a little wiggle room.
What do they mean by the opportunity cost of it?
Basically, what kind of, again, pure opportunity cost is if I do option A, what could I have done if I'd have done option B? What am I foregoing? So basically you're saying, okay, if they didn't invest in us, what could they have done investing elsewhere? So in essence, what do we feel like they need to earn in order to attract them and keep them, so to speak? And again, that's a little bit more additional than what true opportunity cost is, but in essence, that's what they're trying to tell you. What kind of return do our shareholders expect? And because the thing of it is, what happens to companies that are not earning? Price of stock goes down, nobody will buy it, right? What happens when things are going great guns? And again, it's stock prices and all that. Remember, funds we get are based on what the stock price is, right? Number of shares we issue, what someone's willing to pay. It's not only is it what you're actually doing, it's what the perception is, right? That's why in the late 90s, everybody's buying all these .com companies. They didn't have good assets or anything in their favor, but everybody saw, we're going to a purely computer society. And, everybody was buying on that, thinking it was going in. I think, I was talking about cartoons earlier in the other class we got some. And I told them, I said, when y'all growing up, and still today, because I'm back into watching cartoons again with my grandson, y'all's cartoons suck. They're terrible. I hate these Japanese type cartoons and all that. Don't get them, don't understand that. Pokemon, all that junk. And give me Bugs Bunny, the Roadrunner, the good ones. Those were good cartoons. But I saw a cartoon once. I don't know if y'all ever watched Adult Swim on Comedy Channel. You ever see? It used to be Harvey Birdman. I don't know if you ever saw Harvey Birdman, Attorney at Law. You know what I'm talking about, right? It's a spoof of stuff, and it's hilarious. Now, people your age may not get it all because it's really aimed at somebody my age. But one of the things, what it does, Harvey Birdman defends different cases, and it's usually cartoon characters, really back from the 60s and 70s. They've done the Flintstone. The Flintstone one is just a classic. I've got that on tape. I watch it every now and then just to put on. It's based on The Godfather and what was the HBO series?
Sopranos.
Huh? Sopranos. Yeah, it uses the soprano music and stuff, and Fred's The Godfather type thing. But the one I was thinking about here was the Jetsons. If you've ever seen the old Jetson show. Well, they're coming there to sue somebody, and what they're doing is you're using the stuff from Jetsons. They're saying we're from the future, and what they're doing is using the stuff from the '60s of what people thought the future was. And of course, Harvey Birdman's sitting in today's time. And it's like, the Jetsons make a phone call on a cell phone, portable phone, which back then was about like this. And he's calling, he goes, this is a phone, I don't have to have a cord on it. It's from the future. Of course, Harvey Birdman's flipping out his little phone and making a call on it. And they do all kinds of things like that of what people thought the future was going to be in the '60s. I mean, we all thought we'd be, if you go back and look at some of the weekly readers and stuff in grade school, we thought we'd be riding jetpacks and flying cars by now. Seriously. People thought we would be doing, or, you get your car, you program it, and then you don't have to drive it. It gets on there and it would prevent accidents by keeping you so far from every car and routing you around like on a train track or something. Yeah, but the future doesn't always turn out like that. And .coms, everybody thought we were going to do that in the 90s. And they were selling stuff, and so their cost of capital was high because they had that expectation. And it didn't exactly turn out that way, as we all know, unfortunately. But anyway, again, just looking at the cost of capital, we know are on. And it does eliminate the dysfunctional behavior. As we said, if we have, long as the ROI on a project is above our cost of capital, it's going to give us positive residual income. And so we do eliminate that. Now, again, like I said, as long as it equals 20% or greater, I would say that it's got to at least be $1 positive where there's no real sense doing it. Because why do it if you're just as better off and you're at the same level? Now, here we go with the economic value added, EVA. And again, basically how we're going to define this is the annual after-tax adjusted divisional income minus the total annual cost of capital. In other words, it's going to be a lot like residual income in the calculation, only we're going to manipulate the numbers a little bit. Now, by the way, I'm going to give you, examples will tell you what to do and all that, and how they're going to manipulate it. In real world terms, everybody has their own formula of how to do EVA, how they're adjusting, how they're adjusting income, how they're adjusting invested assets. And the thing about it is, you tell everybody the rules up front so they can make decisions that will benefit them, their division, in making it, if they know what the rules are. If they don't know what the rules are, again, throw a dart in the dartboard, you guys much chance, right? And so, we do tell them up. And just because one of the ways we look at it here, that's not gospel to say that everybody does it that way. They don't. Everybody will have their own ways of tweaking things. It's just, you just tell everybody beforehand, hey, here's how we're going to do it. Here's how we're going to calculate it. Now, a very common one is, again, EVA. Like I say, it's just the after-tax plus or minus any adjustments, minus out that divisional investments, plus or minus any adjustments there. Again, very closely tied to residual income. In fact, it looked a whole lot like it. But we are manipulating both sides of it. And what we're trying to do is eliminate these accounting distortions. You say, what do you mean? Well, we know R&D is expensed immediately, right? No matter what, we expense it immediately. Well, I take that back. We generally expense it immediately. If it's R&D that we can apply to multiple projects, then yeah, we can depreciate and amortize it over those projects. But like you say, well, if you got a building, R&D building, you do all your projects there, you would depreciate the building, even though it's tied to the R&D because it goes to multiple projects. But a lot of times what we would do, a very common thing is that we will take that R&D and spread it out over the years that we get benefit. and we'll expense it off over those years. And so we add it, instead of expensing it immediately, we add it back to net income. And also we add the unamortized portion back to the assets, that investment. And that, again, that's a one that's very common. And basically what we're doing in our calculations, we're amortizing that R&D over its useful life. And again, basically what is the EVA is just exactly what we would have done with residual income if we hadn't accountingly deducted these amounts. Now again here, just an example here, we got advertising expenditures in year 1 and year 2, and again they charged 50% to year 1. And they believe an advertising campaign has a 2-year life. So, you know, advertising expenditures in year 1, we're going to 800,000 times 50% plus 1,200 times 25. And again, remember GAAP says we expense advertising when incurred. And so you have the divisional income. We add back our expense that we subtracted when incurred to get a new income, and we do amortize that advertising in year 0 and in year 1, and we get an adjusted income, and the divisional investment less the current liabilities get our net investment. Take that and add in our unamortized advertising, and now we're coming about, we got a 20% cost of capital, we get our EVA. Now that's a jumble like ranch and working through it. Let's see here. Yeah. Let's see. See if I can come up with a little bit better. Okay. Now, we got 2 product lines here. We got a pain reliever and a weight loser. And they spend heavily on R&D. And they give us this information here. Now, notice it says we spent, in the first year, year 1, we spent $300,000 in pain reliever, and weight loser, we spent $150,000. Now, they estimate that R&D expenditures have a 3-year life and amortized to following schedule: 1/6 in the year incurred, 1/3 in the next 2 years, and 1/6 in the fourth year after the initial spending. And if you add that up, that is 100%. Now, it says calculate EVA for this company in the 2nd year of operations. Now, that's okay. Where's those announcements? We've done that in the class, so I can do that. Okay. Let's just sit here. Let's just go through and let's make a couple of columns here. We got pain reliever, and we got weight loser. Pain and weight. Weight is a pain, I can tell you from experience. Now, after-tax income is given to us, right? I'll show you. After-tax income is given to us. It's what, 275 and 210? Now, we're going to add back what? Did we say?
The R&D.
The R&D. So R&D has been expensed out of the 275 and 210, so we gotta add that back. So it's what, 450 for a pain reliever and 300 for the weight, which gives us income before amortization of R&D. 725, check my math, and 510. Stand those two numbers together. Everybody still with me? I'll show this. Just keeping up what the problem is here. Now, we have to subtract out amortization. Now, here's where it gets a little dicey. What year is this?
U2.
This is year 2. So, what is amortization? How do we calculate it? Let's do pain reliever first.
It's 100,000 this year.
Huh?
For year 2, it's 100,000, but for year 1, it was 50,000.
For year 1, it's what? How do we amortize this? How do we amortize it? Tell me. What's the formula?
It's gonna be 1/3 of 300,000 plus 1/6 of 450,000.
That's exactly right. Remember your formula. We amortize 1/6 in the year incurred, 1/3 in the second and third year, and 1/6 in year 4. We're in year 2. So we look back up there, we spent 300,000 in year 1, right? Well, we're in year 2. So we're going to take 1/3 of that. So 1/3 of 300,000 is 100,000, right? But we also spent 450,000 this year. 1/6 of it. So 1/6 of 450,000 is how much? In other words, and by the way, let me give you a little tip when dealing with 6. Don't say 1 divided by 6 and get some percentage and multiply it by 450,000. Take 450,000 divided by 6. And that'll give you 1/6. Because that'll give you a round number more often than if you do it the other way. So what is 450,000 divided by 6? 75. So our amortization would be 175,000. Everybody okay with that? Again, it's 1/3 of 300,000 that we spent last year and 1/6 of the 450. What is it for weight loss? Huh?
100,000?
Yeah, I just looked at the answer the guys got here is wrong. I agree. I think it's 100,000, don't y'all? Again, how do we do it? Well, we take 1/3 of 150,000 because that's the second year. It says weight loss. Weight loser spent 150,000 in year 1, so 1/3 of that is 50, right? And then we spent 300,000 this year, and so that would be 1/6 of 300 would be also 50,000, would it not? And so that's 100,000. I think that's funny.
What insurance do you have?
Huh?
What insurance do they have?
They have 55,000. And I'm looking at it going, how did we get that? That's wrong. Okay. Now, God, it's all screwed up. Then he added it. You don't add, you subtract. Amortization.
You have to add it to the investments or subtract it from the investments
No, I mean,
or is there you include?
I'm looking at it and I'm thinking, no, I would subtract this, that 175 from the 725. It's less amortization of R&D, right? We didn't amortize anything here. So, and what I'm doing is this right here, since his answer ain't right, I would say less amortization. And so what do I get here? 550, and over here 410. And again, that's the adjusted divisional income. Okay, now we got to go in and adjust our assets. So we got divisional assets. And we go back up here, and that's given to us right there, 1,365,000. We're on overtime. And that's 982 is given. To this, what we're going to do, we're going to subtract out current liabilities. $584 and what? $397. And what do we come up with here? What's this number? Something one. Ain't gonna rely on this guy's answer, he's totally wrong.
7.8.
781. Again, this is net investment. And over here,
585.
585. Now, also, what we have to add back is unamortized R&D. And how we get that is we go back and how we calculate amortization expense up here. We had what, 300 on painkiller. We had 300,000 the first year, right? And we amortized a sixth, and we've amortized half of it, right?
Yeah.
So we got 150 left, and then in this year we amortized the sixth of the 450. We said that was 75,000, so there's 375 still unamortized, and 150,000, and that is what? Add those two numbers together. 150,000 and 375. 525. Everybody okay with how we got that? Half of the initial, because we took a third and a sixth, that's 3/6. So that means 3/6 is still not of that for year one, and 5/6 is still not amortized in year two. And the same thing with weight loss. We spent 150,000, and half of it has been amortized, so that leaves 75,000. And we got 300,000. We did 1/6, so that was what, 50?
Yeah.
So we got 250. So 75 and 250 is 325. Got to add that back. 910. And then here we got what? 6. Mean 306. Is that correct? I think. Now we simply go in and calculate the EVA. And we'll look at that on Friday, but what we're going to do, we'll come back to this. It will be 550 minus our cost of capital times this, 410 minus our cost of capital here. And we'll pick this up since we're a few minutes over.